Ladies and gentlemen, welcome to your favorite podcast. This is Real Estate Investor MBA.com. We created Real Estate Investor MBA to leverage the knowledge of giants through synthesizing and providing much needed information to all investors, from the veteran investor to the new and aspiring investor. At Real Estate Investor MBA, we plan to cover pertinent information head-on with our expert guests who we will interview on what they are doing and preparing for in the days and years ahead. We aim to create MBA quality curriculum topics and themes from the information garnered among our interviewed guests in order to bring world-class value to our fellow community of listeners. We truly believe that rising water raises all ships, and by sharing this leveraged knowledge, we can create a stronger online community, which translates to stronger local, regional, and national communities. Your hosts are Jeremy Moyer, who is a veteran real estate investor and author of a new book called Are You Playing the Real Estate Game Blind? As well as Tejas Gosai, the owner of eXp Realty, the Tejas Gosai team, and also co-manager in a newly formed Regulation D private equity fund called the Lehigh Valley Private Equity Fund. Now let's get to the show.
Welcome back to the Real Estate Investor MBA. My name is Jeremy Moyer and I'm one of your hosts. As always, we like to start out with a huge thank you to all our listeners and all the supportive comments that we've received over the last couple of weeks. Please check us out on our website, which is realestateinvestormba.com. Today, we have Drew Maconachy. How you doing, Drew?
I'm doing well. Thanks, Jeremy. How are you?
Good. So Drew owns and operates Maconachy Stradley Insurance, one of the fastest organically growing agencies in the country. Drew focuses on insuring real estate-related risks and insures over 5,000 doors across the country with a goal to insure 20,000 by the year end 2022. He breaks down complicated insurance concepts in a manner that's easily understood. Insurance is such an important component, within real estate investing, and sometimes the types of coverages can just easily be overlooked by how cheap of a policy one can find. Having experts like Drew on the program is really great because it helps to highlight how valuable a role your insurance agent or broker can play, which is really a must for anybody to have on their team. So Drew, thank you for your time again this morning on being on the show.
Of course. Thanks for having me on.
Absolutely.
I've listened to some of your guys' episodes. It's been really impressive. So, doing my due diligence on you guys, right? So, I'm very impressed with what you guys are doing and excited to have a conversation.
Sounds great. Drew, can you just give a little bit more about your background before we jump into some insurance questions?
Sure. Yeah. So I got into it. Well, I've been in insurance forever. My uncle owns an insurance company. My sister's a reinsurance broker, so she sells insurance to insurance companies. My dad ran this business before I bought him out, 6 years ago now. So it's a family business, right? I mean, even if it's not Maconachy Stradley, the whole family's in the dang business. So we can't run from it. Got into real estate myself right out of college. I was doing putting together mortgages for very large businesses. I love the real estate business. So then that was in 2007 when the world was ending. So that business dried up very quickly, and I transitioned back obviously to the insurance side. But always love real estate. I'm a passive investor. Just have always been interested in real estate. So it was a very simple transition into specializing in real estate related transactions with regards to insurance. So, I look forward to our conversation today, and hopefully you can stump me.
I'll try. Perfect. Well, let's just kind of jump right in. I think the basic coverages, I think, makes a lot of sense just as an opening to the show. So, from a basic coverage standpoint, that each real estate investor really should have or should consider, whether they have them or not, what should they be keeping in mind?
Sure. So the most obvious one is property coverage, right? You're buying an asset. If you're going to have a bank on the asset, they're going to require that you have it too, of course, to protect their interest in your asset. But property coverage, first party, meaning if the loss happens, the claim payment's going to be made to you. Fire, your building burns down. You have if you buy flood coverage, you've got water coming in from the outside. You're going to get coverage for that. Vandalism, very common one right now. Actually, obviously, with if you watch the news at all, there's been a lot of vandalism to assets across the country, especially if you're buying investments that are in cities. So, any sort of issue that creates a coverable loss to your property, a property policy is going to pick in. The other main coverage that probably everyone buys is called general liability coverage. It's third party, meaning if the claim happens, the insurance company is going to pay a third party. So slips, trips, falls on your property. If you've got if you've got a bad sidewalk and somebody trips over it and hurts themselves, or say they tripped over it and hurt themselves and you get a fraudulent claim, the policy is going to pay to defend you as well. So a lot of times what we see is no claim payments made, but the insurance company steps up, use their high-powered, expensive attorneys to get you out of the way. So very valuable coverage. Even if a claim's not being paid, they're going to defend you in the court of law. So oftentimes that's the more expensive side of the claim payment anyways. So those are the two most common. What we see probably 50% of real estate investors buy is what's called an umbrella policy. It's third party, so it sits over top of your general liability coverage. And it also, if you have any sort of other third party coverage, if you buy if you're required to buy a pollution policy, it'll sit over top of that. If you have automobiles that are on your policy, it'll sit over top of that. And it just adds another layer of protection. So if you had $1 million of general liability coverage and you buy $1 million of umbrella, now you have $2 million of coverage. So it doesn't, a lot of people think it sits over top of your property coverage. It doesn't. Very common misconception. So don't undervalue your building to save premium dollars thinking that, oh, I've got this umbrella policy. I get that a ton. Well, I know I'm a little undervalued, so let's just buy an umbrella and then, we won't have to worry about it. No, can't do that. So those are definitely the three most common. One I want to throw in real quickly is directors and officers coverage. If you are syndicating deals, if you're using investor money to buy your deals, and for whatever happens, you tick off an investor, you don't live up to your pro forma, blah, blah, blah. They think that you're shady and they sue you, anything, right? They don't like the color of your shirt and they sue you. This policy would step up and make you whole from that event. So as long as you are not cheating, if you're a bad person, it excludes intentional acts. So as long as you are not trying to defraud your customers, this policy will pick up. There's no coverage on a general liability policy for that. So something that very few people buy, and with real estate's low, it's kind of hard to screw deals up right now. Right. But that's not going to stay the same forever. So I think deals will get tighter over time, and that'll be a very important coverage to keep people in business in the next 3 to 5 years, let's say. Okay,
you just covered a lot in a couple of minutes. So let's rewind a little bit and unpack some of that. So I want to definitely talk about the director's coverage in a second. But the one before that, the umbrella, you did mention a common misconception. Do you mind just explaining why not taking out the appropriate amount of coverage on your general policy is not a good tactic, and overlaying that with an umbrella, just what are the hiccups there specifically? Because I do know some investors that do that with that thought in mind. So
so on a general liability policy, typically speaking, the industry standard is a $1 million per occurrence policy, meaning if you have a loss, the insurance company is going to pay up to $1 million. After that, you're on your own. And then there's a $2 million aggregate. So you could have, in any one policy term, you could have 2 $1 million claims, you could have 4 $500,000 claims, so on and so forth, right? It will give you up to $2 million of coverage. So typically, if you're a smaller investor, if you have 25 units or under,
Mm-hmm.
I would argue that you could save your money, right? Don't buy an umbrella. You're not to the point yet where you could face, a $5 million claim, for example. But if you are, as you're scaling up and buying more and more units, or if you're in like a high rise where somebody could be out on your balcony and fall off your balcony and have a really substantial claim,
Mm-hmm.
that's what I would look at, right? What are my exposures? And frankly, this should be a conversation you're having with your agent and attorney to say, what are my exposures here in this building? If I'm in a ranch type of apartment building or single family home, man, do I hold a lot of liability that could get up to $5 million? No.
Mm-hmm.
But if I have a 12-unit apartment building or a 4-unit apartment building and I've got patios or balconies, yeah, you do. I mean, your tenants are going to have people over. They're going to want to show off their cool balconies, and you're going to get 12 people on a balcony that's made for 6 people. And,
Mm-hmm.
We've all heard the horror stories. So
Yep.
Understand your exposure, have your insurance professional help you understand your exposure, and then, listen to them, lean on them. I tell people I'm part of your team.
Mm-hmm.
I'm not some schmo you go out and say, find me the cheapest deal. That's not, if that's what you're looking for, I'm not your guy. I will find you the best deal that's available with what I would say are the correct amount of coverages. Now, you don't have to buy what I tell you to buy, but we at least need to have a conversation about it. And I want you to understand what you are buying.
That's great. Thanks for explaining that.
Yep.
So specifically for the directors and officers coverage that you mentioned a couple of minutes ago, what can you give us an example of, maybe a client in the past that utilized this or didn't utilize this where they should have, and were exposed from a lawsuit, just to kind of give some context to the coverage?
Yeah. So a great example is the first one that I said before is the one that happens, right?
Mm-hmm.
You have a bill, you are behind, you're underperforming on an investment that you put together where you've raised capital from outside, what we call interested third parties.
Mm-hmm.
So you've raised capital and it's underperforming. You go through all the remedies, right?
Yep.
Let them try and sell their equity to another member that's in it, or they need to get liquid, right? I need to get liquid. Let me out of the deal. I can't let you out of the deal, or I have to let everybody out of the deal, right? There's that scenario too. But so the deal was underperforming, and there was a suit, right?
Mm-hmm.
That honestly, it happens every day. The more people that I have, the more I'm going to see it, right?
Mm-hmm.
But and again, this is bigger deals. These are as you're starting to take 6 figures from people, 7 figures from people. Guess what? They have means. So if you're underperforming, they're going to say, okay, well, I'll use my attorney to go get my returns for me instead of this asset that I invested in. So you got to be mindful of that as you scale up, you're going to get people that have already scaled up. That's why they're passively investing with you. So
right.
They have means to come after you. So this is a great way to protect yourself from your investors. The only way to protect yourself from your investors with insurance products.
Okay. And then does the insurance company, they evaluate how much you're raising, your experience?
Yeah.
Right?
Part of the underwriting process, they'll ask you for your deck or your PPM, whatever word you want to use.
Mm-hmm.
So they will look at that, and it's nice because they'll actually give you some suggestions on how to make it stronger. So you can kind of use them for a little free legal work. They'll look at that. They'll look at your past deals, how they're performing. But it's mostly about that PPM, because if you have a really tight PPM, a lot of that risk is transferred onto your investors, aside from you just cheating them. So, and if you cheat them, the policy is not going to respond to that anyways. So once they help you set up all that risk transfer, that's a big piece of the deal. And then at that point, the policy should just not technically, but probably will just be used to defend you. And we won't have to pay settlements because we have such a tight document set up.
Mm.
So you're paying them to keep a $100,000 lawsuit off your books.
Right. Oh, great. Thanks for explaining that. I think that that makes more sense with an example. That's perfect.
Sure.
So, any other types of coverages that are, I've never, I think I recently heard about the director's coverage within the last couple of months. But any other coverages that are kind of unknown that we should know about, kind of like the directors and officers coverage, not something that's widely talked about?
Yeah. So from a whole policy standpoint, right? I mean, you've got the four things I've laid out are their own policies. They're not going to be written as a package, or you can't add them into anything else. So there's one other policy that people should be considering, which is pollution coverage. Almost nobody buys it, but if you have mold and fungus, that's excluded on all policies. So if you get mold into your walls, you're not going to have coverage unless you buy either a pollution endorsement or standard pollution policy by itself. So they're relatively expensive, but they're expensive because the claims are really expensive, right? The more expensive an insurance policy is, that's the more likely you're going to have to use that insurance policy. So think about it that way when you're going through when you're looking at something, right? And say, wow, maybe I need this. And of course, the way to decrease the cost of a policy, if you think if it doesn't work with your numbers, right? Well, you can increase your deductible. You can carve back some coverage. Say, if you can identify something very specific that you're looking for coverage for, we can target that. We can exclude everything else and make it a very customized policy to your needs. But again, if you say, okay, I bought this building, they've had 6 mold issues in the last 8 years, I need to buy a pollution policy. Guess what? It's going to be really expensive because the insurance company, you got to understand the insurance company, they're pretty smart. They don't like losing money either. So my first suggestion to you would be working on ways to remediate whatever issue is creating all that mold. And then once you do that and show the insurance company, hey, we're taking steps to fix this, that's going to drive your insurance costs down. So it's very hard to kind of one up or sneak one by the insurance companies. So again, use your agent to help you determine how to drive costs down, right? There's a million ways to do it through asset improvement. Too many things to go through here, but and there's a million scenarios, right? But that we do that a lot. I'm on the phone a lot. Just here's what, how can we get our costs down so that I can sell my building for a higher multiple? And that's a big part of my job. So that's one area. And then, so specific coverages within other coverages, assault and battery, that on a GL policy, that's being excluded a lot now. There've been a lot of, tenant on tenant fights, and then you get brought into a claim, especially tenant on tenant. It breaks out into the hallway. Somebody falls down a flight of stairs and they say, well, I wouldn't have fallen down the flight of stairs had the carpeting not been bunched up, even though I was fist fighting next to the stairs. Right. And you get brought into a claim. Right. So that instance that I just explained, coverage would be denied if you didn't have assault and battery coverage because the proximate cause of loss was them fist fighting. So it's you got to be a little careful with that. But assault and battery, abuse and molestation, if you think about it, you have to kind of get creative with it. But if you are evicting somebody or somebody calls and says, we're hearing some funny noises in unit 112, and you open the door and your tenant is naked, or they say they're naked, and you go in, well, that's molestation. So, kind of a sexual assault type of thing. So, that coverage is very commonly being excluded. So just make sure that you're looking at that when you're getting quotes. Those are the big ones. Ordinance and law is huge, but I think most investors are starting to understand what that is, right? If your building is grandfathered into code and you have a loss, and now we have a construction site, all that grandfathering goes away. So now you have to bring the building up to code. That all those code improvements are not going to be covered under standard policy unless you have ordinance and law coverage. Can be. I had a customer who lost $800,000 on an ordinance claim. They had a $25,000 sublimit. They thought that was enough, and it was a 60-year-old building in Cleveland, and they had a partial fire to the building. Obviously, that opens it up before you're allowed to reopen the building. It has to be brought up to code. $800,000 shortfall.
Whoa. So we're in the Northeast, so we have a lot of older buildings, a lot of brick buildings that investors buy that, they might update a couple units or they might update the entire thing. So let's kind of dive into that one a little bit. So give us a scenario with that client. Was it a fire loss? Is that what it was?
Yep. So it was a fire. It was a big loss. It was the fire portion of it. I think he got like $600,000 or $700,000. So it was like a quarter of his building. It was maybe 100-unit building, and so that they've gone out, they've gotten all the permits to do reconstruction on the building, but now you've got the county coming out to look at the building too to say, okay, let's make sure everything's up to code. And they came out and your railings are too low and your, everything. I mean, there's a million pieces of code that change over time. And once you have a active construction site, everything needs to be brought up to code. So that was the specific issue there. And it's like that can happen. That it didn't need to be a $250,000 claim to create the issue. It could have been a $50,000 water loss.
Yep.
If you're out there, if you're pulling permits, they're going to, the code people are going to come out and make sure that you are up to code. And if you're not, get ready.
So as the insurance company, let's say we have, where's a good rule of thumb? Like if you have a building that's 50 years old, or older, or is there a good rule of thumb of when to seek it, or just to talk with your insurance agent, broker, when you're looking at a building, just get their advice? Yeah.
So there's two things, right? So if you're doing due diligence on a building, have your inspector tell you if the building's up to code, right? That's a great way to catch it. And he can tell you what's out of code. So then, all right, well, if I have an issue and I need to pull permits, I'm going to have to bring all of this other stuff up to code. So he can give you an idea of what will need to be upgraded at the time of loss. From a year standpoint, it changes, right? I mean, some states are, more liberal, some are more conservative with their codes.
Right.
But I would say if you're in the 80s or newer, your numbers shouldn't be crazy, right? We've already kind of, at that point, we've gone through the big ones, the wiring, the plumbing, the HVAC, all of that stuff. The asbestos, all of that stuff should be out of the building. So I would say kind of if your construction is the 80s or gut rehab since the 80s, you're better, but it's certainly not perfect. You're certainly not going to have no issues.
Right. So as the insurance company then for your due diligence, if one is seeking this coverage, are you going to want to tour the building, see, or even meet with the inspector, kind of see the list of what's not up to code, just so you have your full list of what might need to be covered?
The insurance company isn't going to require, it would be smart, right? But that would take a ton of underwriting, right? That would take a lot of dollars to get people on the boots on the ground. Generally speaking, post inspection, they'll come do, post binding. So if you buy a policy with an insurance company, they're going to come do an inspection. And at that time, they'll identify if there's, 6-figure issues there with regards to potential ordinance and law claims. They'll identify it at that point, but they want the premium on the books before they're going to start investing back into, inspecting the building.
Sure. Okay.
So it's not great because they'll give you a list, but the list is late, right? You would rather have that information pre-purchase, which is why I would kind of rely on your inspector.
That makes sense. That's great to know. So are there a few things, during due diligence that sometimes investors commonly overlook, not think of, that they should be aware during the due diligence process?
Yeah, I'm pulling my cheat sheet up so I don't miss anything. I've made a cheat sheet. So first thing I would do is get a copy of their policies, right? Seems super simple. Get a copy of the everybody's like, what's the insurance going to cost me on this building? There is insurance on the building now, right? So take that number and plug it into your pro forma and go from there. It's not going to be too substantially different unless they own the building outright and have pulled a ton of coverage back that your lender is going to require. So if you're taking money on, you have lender requirements to live up to. Those lender requirements, lenders typically require pretty, they're pretty conservative, right? So they're going to make you buy a lot of coverage. If the building is owned outright, a lot of I look at a lot of deals now in like Louisiana, coastal Louisiana, where they don't have wind coverage because it's 50% of your insurance cost is to buy a wind policy. But guess what? It's far and away the most likely cause of loss. So that's where, my story can get beat up a little bit. But generally speaking, if you get a copy of their policy and then send it to your agent and say, how does this match up with lender requirements? What would the difference in cost be, right? But that's a simple one that everybody should be thinking of. This is a new one, 5 years of loss runs. So the insurance company wants to see how your building has historically performed. So as you're doing due diligence, make sure you're asking the seller for 5 years of property and general liability loss runs to see, if we're in a wind zone, have we had a tornado? Have we had a hail claim in the last 5 years? Because if you've had one in the last 5 years, it's much more likely that you're going to have one in the next 5 years. Right. So it'll also, if we've had fires in the walls, it'll tip the insurance company off that, hey, you may have unmitigated aluminum wiring, right? Why are we having fires in the walls? That would be a common trigger for that. So get 5 years of loss runs. Insurance companies are typically requiring that now on any larger, 100 units or more, probably 50 units or more. They're requiring loss runs in order to give you quotes anyways. So you might as well ask for it.
And would those be from the other insurance company directly?
You would get that from the seller. The seller would request that from their agent.
Yeah. Okay.
So those first two things you just ask the seller for. When you're doing your inspection, we want to know if what the electric is. Is it copper or is it aluminum? And if it's aluminum, how has the aluminum been mitigated? I shouldn't say that. A large chunk of the aluminum deals that we see have been mitigated. So we want to know how it's been mitigated, what process. There's like 5 different mitigation processes. I've learned more about wiring in the last 2 years than I'd ever care to learn about. But plumbing, right? What year was the plumbing updated? HVAC and roof. When was the last time the roof had major work done to it? If we get just the years on those, that's going to get you a long way into your insurance due diligence. What's the building constructed from? If it looks like it's brick, is it brick through and through, or is it brick over frame? Most of the time it's going to be brick over frame. Brick is obviously much better than brick over frame. From an insurance standpoint. Are the buildings sprinkled? Does it have central station fire alarms, like hardwired fire alarms, or are they just, the battery operated units? You'll get a couple percent credits if it's hardwired. So it can be a substantial money saver on a large deal. Crime rating. So a lot of insurance companies now are running this to say, all right, how safe is the area that you're in? It's a good idea to run that because you're going to see that's going to change your costs, right? Because if crime rates are high, then it's very likely that there's going to be break-ins and vandalisms where you're turning claims in. Couple other quickies, right? Percentage of the building that's subsidized. How many subsidized units are in it? If it gets above 5%, it's going to start kicking out a lot of insurance companies. If it gets above 25%, it's going to kick out a whole heck of a lot more. So the less subsidized housing units, the more insurance companies are attracted to it. Pools, playgrounds, get the square footages. Right? I have a lot of my customers have a hard time telling me how big their buildings are. So do that math quick and get that out, because square footage times construction costs equals the replacement cost of your building, right?
Yeah.
So that's a imperative. I can't underrate your deal without square footage. So on a larger location, there's what's called a property condition assessment report. It's essentially a fancy survey. So it'll tell you what does the building look like. Here's where you should spend your money to upgrade the building. The insurance companies love to see that. It tells them, is this an A building or is this a C building? And that's quantifiable, right? We can look at a report and say how nice is the building versus an investor saying, oh, this is B plus when it's really C minus.
Right.
And then on top of that, like a construction budget, if you're going to fix the building, tell the insurance company. If you're going to make an asset nicer, guess what? That's going to save you money. So tell the insurance, here's where I'm going to spend the money to make the building nicer. I'm adding value to this building. Insurance should be cheaper than it was last year because you're now getting a better asset. So it's a lot of lipstick, right? Put lipstick on it and get yourself a better deal.
That's tremendous. No, thanks for reviewing that list.
Sure.
So is there an example of, you brought up the loss reports early on in that list. Is there an example of, you had a client that came with you and they provided the last 5 years of reports and, any red flags that you see when you're reviewing? Can you just go over that for a couple minutes?
Yeah, the quick one is small fires. So if there's a bunch of small fires, right? We either have tenants who aren't turning off their stovetops, right? Very fixable, right? You could go to Amazon and buy a stovetop fire suppression unit for $30.
Yep.
Install those above all your stovetops, and you can eliminate that risk. By the way, then we can say, hey, you've got you're debiting our pricing for all of these stovetop fires. We're putting in suppression units, so they'll credit that out. That will save you money on premium. Also, small fires, again, if they're in the walls, that's going to tip the insurance company off that you have wiring issues. So it's good for you to know, right? If you've got wiring issues, you want to know too, because you're going to be able to buy the deal cheaper because you're going to say, hey, you got issues in your walls. We're going to have to spend money on this. We want to credit a sale. So those are two easy ones. I mean, if you're in a it's good to see if there was a flood at your building, right? Then you're going to know if there is potential to have water in your walls, mold issues, right? Again, mold issues are typically excluded on policies, so you want to be very watchful of mold. So if your area is flood to prone, or if you've had a bunch of water losses, that's a good way to determine if there's a high likelihood for there to be mold in the walls. Those are kind of some low hanging ones. I mean, if you're in a wind zone, of course, you're going to get wind claims. It would be nice to know how often you're getting wind claims, but that's expected, right? We want to try and search out the stuff that's not expected that we can fix, hopefully.
Right. And then those claims, potentially how large they are, how frequent they are, that would potentially affect future premium costs?
Substantially. Yep.
Substantially.
They're plugging those numbers in. They'll give you a credit if you haven't owned the building, right? But if you've owned the building on it, then if the asset's big enough to be underwritten on its own merits, that's how pricing's driven. They're going to take your losses. They're going to put their fixed costs on top of it, right? They've got to pay their underwriters. They've got to pay their inspectors. They've got to pay their claims managers, right? So they'll build in 30% ish. And then 10% of profit on top of that. So it's like 30 to 40 to 50%. An insurance company is going to build in on top of expected losses. And then they're going to hand you a premium. That's your premium. Wow. If you have a single family home,
yep.
If you've got 3 single family rentals, no, you're not being underwritten on your own. They're grouping together a geography of 1 million single family rentals. And adding all the losses up, dividing it by the number, and here's your dollar. It's not that simple, but that's kind of how they do it. But on these huge deals that they are underwritten on, I used to be an underwriter on large deals, so that's exactly what I did. We inputted the loss data, and You take some trends, you trend out all other large assets like yours, and but probably 70% of the pricing is based upon your own experience. So
that's tremendous. That's going to be really important when you're under, an operator's underwriting a deal. And if you're looking at historical on the building, right, insurance, and it's something just happened, you
yep.
have to bake in that premium increase in your new numbers that could grossly affect your cap rate. Yeah.
Yeah, we see it. You're absolutely right. I've seen a lot of deals in the last year. In my opinion, these deals are on the market because of insurance, right? And a lot of Texas deals, right? Harvey came through and created a loss, and now we've got another loss coming. Right? We had the big freeze, right, in Texas 2 months ago. So these people are like, man, I banged the insurance company for $1 million 3 years ago when Harvey came through, and now I've got another $800,000 loss because we had a bunch of pipes break. My insurance costs are going to go through the roof. I can show people that my insurance costs right now are $200,000 a year, right? But and I'll get my multiple based upon that. Whereas next year it's going to $300,000, and that's would just eat up my multiples. So I'm of the belief, and this is everybody thinking they're a little more important than they are, but I'm of the belief that a lot of insurance costs, right, or a lot of deals are on the market right now because of what's happening in the insurance market.
Wow. So it's even more important to be diligent and working with your insurance agent and broker, right, to really incorporate them during the due diligence process, and more than just here's a building and I need a quote just for general insurance. Right?
Yep.
Yeah.
I totally agree.
That's tremendous. No, thanks for sharing that.
Mm-hmm.
So, Drew, we're winding down just to the very end of the show. You brought up a lot of really great points about insurance coverage. I hope I gave all of us a lot to think about, and also to talk to our insurance provider like yourself to make sure we're all properly covered. Can you tell our listeners a little bit more how they can get in touch with you if they want to learn more about you or to potentially work with you?
Sure. Best way to honestly, the best way to start a conversation with me is on the phone. If I get an amount of emails that would make you sick to your stomach, I won't even tell you a day. So if you want to get me, you just call the office line, which is 330-966-5170. Ask for me. We'll also tag I assume you'll tag my email address in the show notes, and
Will do.
We can put that in the show notes, but I'd be happy to have an introductory call with people and kind of point you in the right direction. A lot of times I think we're the best people to help you, but there's a few instances like vacation rentals. I can point you in the right direction on that stuff. I'm not trying to make all the money in the world. I'm trying to help people get good protection. These real estate investors are great people. They work hard. They're good for our country, right? So I want to help them as much as I can, and hopefully I make a little bit of money on the way. But if I can't help you, I know somebody who can.
That's tremendous. Thank you so much. Everyone, this is Drew Maconachy. I'm Jeremy Moyer with the Real Estate Investor MBA. Please tune in to us next time. We look forward to seeing you. Have a great day.
Thanks, Jeremy.
Absolutely. Thanks, Drew.